All right, what is up, traders? What's up, tycoons? Super excited for today's video. The most telling stat today is this one right here. The number of S&P 500 stocks making 20-day highs, only one. But the number of stocks making 20-day lows is over half, 264 stocks. We're going to start the video off there, and many other really great and interesting stats we're going to take a look at. Global flows. We're going to take a look at large cap tech and small cap tech. We'll take a look at tech relative to the rest of the market, and we'll go over some unsustainable levels in the market and really just all of these divergent things that have kind of been pointing to some pullbacks in the market. Really great data sets that we're going to take a look at. We'll break down the SPY itself, the S&P 500, go over what it is that I'm looking at and give you a review and update on that. We'll take a look at some breadth measurements in the Dow Jones, and then we'll talk about potential reversal areas in certain sectors of the market. All right, and then we'll talk about some more flows here again. And then the VIX also really crazy correlation between VIX and Iran. That's super interesting. We're going to look that up as well, go over that and talk about Israel, and also break down the chart for Israel and also go over Amazon here too. Okay, there are some potential long opportunities here. Now, we'll go over those. We'll go over, what could happen there. And we'll take a look at SMCI here too as well. As always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys. It's called Investment Intelligence, giving out free, valuable finance trading content. And I also try to sprinkle in some free trade ideas in there. You can get those directly to your inbox by signing up using the link in the description, or you can just simply review the website. It's kind of like in blog format there as well. So you can go back and read some of the previous articles that we have been putting out. Now, if you want access to all my different analysis, custom scripts, indicators, many valuable resources, and much more, join the Discord, okay? It's $10 a month. And these are some of the plays, from a couple of weeks ago. We were talking about Tilray, back when it was at 222, having a nice 3-to-1 risk to reward ratio. It exploded past those price targets, continued to hold there for a little bit, actually came up and hit this 293 target, ultimately before reversing and dumping. But we went ahead and we did take profit on the Tilray. Valero is another one that was an energy company. This is all the way back in March 5th, guys. So I know a lot of people are talking about energy right now. We're entering in and looking at entering in a lot of these trades in the very beginning of March. And really great opportunities there, right? Valero went up over 300%. We were looking at it in the 140s, ended up going past 180. But let's get into the video here, okay? And the most telling stat, we already went over it. What's really important, guys, is over half of the stocks in the stock market, right? And when we say the stock market, we're just using the S&P 500 as a proxy, are making new 20-day lows. This is bad market breadth, okay? Versus one making new 20-day highs. This is bad market breadth, okay? It's just that simple. You have stocks breaking down right now. You have stocks starting to make new 20-day lows. 20-day lows essentially are a month, okay? There's roughly 20 trading days in a month. So we're talking about stocks making new 1-month lows. Now, these are global flows to equities. The dark blue line rather, is going to be your 4-week moving average. And then the light blue line is going to be your 1-year moving average. And what do we see? Well, we see a little bit of a bearish crossover here at this point, right? You can see we're actually in negative territory. So we have negative flows right now versus positive inflows, and it just absolutely smashed through that 1-year moving average. Now, when you take a look at large cap tech versus small cap tech via the PSCT is at its lowest prices since November, and large cap tech is at its lowest prices since February. Okay, we're now halfway through April. So for many months now, these stocks have been continuing to make, new lows, right? And lower lows. And what we've got here is going to be a ratio chart of the XLK SPY. Okay, this is the XLK SPY chart. The SPY is going to be your denominator in this case. So when you see this chart moving up, it means that the XLK, which is the tech sector of the S&P, is outperforming. And what did we have here, right? We had a little bit of an oops. Okay, we had a little bit of a false breakout here. And, a saying that I want to keep bringing up on the channel and keep getting my viewers familiar with is false moves lead to fast moves, right? It's just that simple. And that's what we saw, right? we had a false breakout up here, and then we saw a very fast move to the downside. As we were approaching this trend line, we were making the prediction that this would break through, and you can see it certainly has. Okay, so remember this line: false moves lead to fast moves. That's something you want to learn and hold dear. Now, this figure here shows two tech-heavy sectors dominate the S&P 500 at potentially unsustainable levels. And what are those two sectors? Well, in bright orange here, it's technology and communication services. Now, you may be thinking like communication stocks, what do you mean? Well, that is the XLC sector, and there's some really big names in the XLC. Okay, you have things like Google in the XLC, for instance. Okay, so those are at what these people, and this is from Deutsche Bank. All right, they're saying that it's potentially at unsustainable levels here. All right, and what have we seen? Well, we've already seen tech, underperforming the rest of the market, right? Underperforming the broad market via this recent chart. Now, if you look at when it peaked in the beginning of 2024 here, and it's been in a downtrend ever since. So, we're already seeing signs via the technicals and as well as, this data set right here, that tech was just a little bit too frothy, right? Now, what's also really good, or just depending on your perspective, right, is you're seeing confluence, right, in this type of analysis. When you look at the value line geometric index, the VLG, now what this is this is basically your median stock. Now, those are at the same levels it was at in mid-December, except momentum is way worse now, right? And when we talk about momentum, All-Star Charts JC right here is using the 14-period RSI. Okay, so we're seeing a bearish divergence here, and we're seeing new lows in relative strength. Meanwhile, the VLG isn't making new lows itself. It hasn't broken past support, right around 570. But we've got this bearish divergence here, right? So it's got way less momentum than what it had, as it was continuing this uptrend and this rally over here. And when you take a look at aggregate institutional net flows, this chart may seem a little bit complicated to you guys, but I just want to point out some simple things to you, right? And let's just make it very simple. The S&P 500 is in black right here. The black line is the S&P 500. You want to pay attention to this red line mostly, right? See how the red line is in a downtrend here? S&P is in a downtrend here, right? And then we start to bottom out over here. We start to bottom out over here. And what do? Well, they begin an uptrend, right? They begin an uptrend. S&P begins an uptrend. And what are we seeing? A divergence in this period, right? We've been in a downtrend now. Meanwhile, the S&P has still been continuing its uptrend. So again, another divergent here, signaling that the S&P, could be due for a pullback and a further correction from where we are now. And when we take a look at it, this chart, this is the SPY daily chart, okay? And we've got a few things on this chart. It may seem, a little complicated, but we'll break things down as simple as possible, right? It's really not too complicated or complex. We've got our RSI here on top, okay? So this is that 14-period RSI. We have yet again another divergence here. Now, in this case, this is actually what's known as a hidden bullish divergence, okay? And I'm going to break down what that term means if you're unfamiliar with it. But take a look how we have a low here, right? And then we have a higher low on the price action, right? On the candlesticks. And we have a low here on the RSI and a lower low. Right now, this is a term known as hidden bullish divergence, and just an indicator, a technical analysis indicator that we could potentially see a little bit of a bounce. Okay, it's not saying we have to bounce or we will bounce, but it's just saying it's very possible that we could bounce. Now, what do we see typically? After we get these really large sell-off candlesticks, right? Like the one that we had right here. Well, what do we see? We end up getting a little bit of a bounce afterwards, right? And take a look at what we had just the other day, a really large sell-off candlestick. And if history is going to repeat itself after these large sell-off candlesticks, even as such as over here, we do tend to get a little bit of a bounce afterwards. So that's something I'll be looking for, right? Is, from a price action standpoint, we see that, we do typically get a little bit of a bounce after these type of candlesticks, right? Now, does that mean that the downtrend won't continue? No, that doesn't have to happen, right? We had a bounce, came down, continued. But this blue line here, this is also your 50-day moving average, okay? And so on Friday, we actually tested the 50-day moving average, and I bought some call options on the SPY, and look at where we opened up the following trading day, right? We opened up much higher and then we sold off very aggressively. And so, I think that we could get a little bit of a scoop and score, aka a false move leading to a fast move potentially here, where we, have a false breakdown under the 50 SMA. And then we get a little bit of a fast move back to the upside that people aren't necessarily surprised or prepared for and could potentially be caught by surprise, right? You combine a lot of these things together, and I think that that's a very possible scenario here. Does it have to happen right now? No. I mean, we talked about breaking below 510 and breaking below 517.50 that we could potentially come down and get this gap fill right around 498. And remember, these gaps, they tend to fill about 90% of the time. The put wall right now, which is going to be a big area of support, is 500. Now, that put wall might change as the trading days go on. But 500 is going to be a really strong support. We might underscoop 500 and come down and fill that gap around 498. But the main thing I want to like point out to people, right, is keep an open mind to the possibility of a bounce here. Okay, it could just be a dead cat bounce. I'm not calling for a bottom necessarily right here. But there's a few reasons I explained in this video why we could potentially see a bounce. Now, what's the overall message that the chart is telling us? Well, we were in an uptrend, right? We put in a top here, right? We put in a nice rounded top. And we broke through two key levels of support, and we're now below the 50-day moving average. This light blue line right here, this is what's known as an anchored VWAP. It's your volume weighted average price anchored to the all-time highs in the SPY. And this basically lets you know who's in control of the price action. When you're trading above the anchored VWAP, that lets you know that basically the average buyer is in profits, right? And so another way to look at that is that bulls are in control, and when you're below there, the average seller is in profit. And what are we seeing? Well, we're seeing the average seller is in profit. And when you combine a lot of these technicals together, it doesn't really get much better, right? What do I mean by that? Well, we broke the channel, we came back, retested the channel, and we rejected, and then we continued heading lower. And then what do we do after that? Well, no candlesticks have been able to close above the anchored VWAP. Okay. So, not only do bears get a clean break, retest, push lower, but bears also are continuing to close price action, at or below the anchored VWAP, right? Each time we've wicked up above, we have not closed there, and we continue to close down below. And I mentioned below 517.50, you can use this anchored VWAP as a little bit of a trailing stop loss for your short positions, just as an idea, right? It all depends on your own risk tolerance or your own risk management. But, if we start to trade above this anchored VWAP, then, potentially we could really be looking for some long positions, again, using that as a trailing stop loss once we start trading below. But for now, really just watching 500. It's going to be a big support level. It's the put wall. Do we break that and come and fill this gap, over the next few days or a week or two? Or, do we get a little bit of a bounce here and potentially try to rally back up to the 510 zone, or potentially back up to this anchored VWAP over here? That's my main technical analysis that I'm looking at on the SPY right now. When we look at the Dow Jones, 150-day and 200-day moving average breadth are hitting new year-to-day lows for the Dow constituents. Again, this is just, bad market breadth, okay? In bullish market environments and in uptrends, you're going to see good market breadth, and in downtrends, you're going to see bad market breadth. And that's exactly what we're seeing is bad market breadth. If these things continue to deteriorate and continue to expand, then that just lets you know that this pullback has some legs to it. It's got confluence to it, and it's got strength behind it, and it could actually continue rather than just being a random pullback that just gets bought up and we continue going higher, making new all-time highs. Now, this is a return risk ratio cycle. This can spot market groupthink and signal potential reversals in certain sectors. On the left here, what do we got? Well, we've got the tech, okay? And so basically these are frothy levels. Once you get up to 2, these signal potential reversal areas, right? Bearish reversal areas. Okay, so we're up in that potential reversal area right now for tech. We've already taken a look at, large cap tech, small cap tech relative to the rest of the market. we've seen that it does not look great, right? It hasn't been super strong. Well, on the right here, we've actually got utilities getting into that, potential reversal area. So, there's lots of different ways to play the market, and you have to remember certain areas of the market are aggressive, all right, and more risk on and signify, more bullish times, and certain sectors signify more bearish times, right? And it's often the case that you'll see more defensive sectors such as things like utilities. Those can actually outperform tech stocks in bearish market environments, in pullbacks, or in bear markets themselves. And we're at an area here where we could be potentially seeing a reversal when it comes to utilities and also tech. So a bullish to bearish reversal in tech and a bearish to bullish potential reversal in utilities. Right. We're not going to spend too much time on this chart right here. I realize it just didn't translate too well for the YouTube. Whenever you blow this image up, it's not too clear, so I don't want to confuse you guys too much. Let's talk about this really interesting correlation here that we've got between the VIX and Iran searches. Shout out to TrendSpider. This isn't something that I would have thought to put together or compare, but when you take a look here, right? I mean, just take a look. When you have Iran being Googled, okay, you see these large spikes. That's what this bottom line is. You see these large spikes, and then you see these large spikes. And the VIX is pretty much going along and following that just as well, right? You see a spike and a big swoop, spike, swoop, spike, right? And even a technical breakout here with higher highs upon the VIX after getting higher highs on the Iran searches. So pretty interesting there. That just goes to show that, hey, these geopolitical situations and tensions that we have right now are causing and are a factor for the increased volatility in the market. It may not be the one and only sole reason why we're seeing increased volatility, but it definitely, is not just a coincidence, in my opinion, how the VIX and Iran, are following. Now, All Star Charts has something here. We're not going to get into politics or morals or anything like that. As investors, as traders, all we're here to do is to make money, right? And try to capitalize off of opportunities. And they're talking about shorting Israel here. And they said how this is continued to be one of the worst groups, one of the worst performers. And I had to take a look at some of the charts myself, right? And so when I take a look at the IZRL Israel ETF, not only is this a Kathy Wood ARK fund, and her funds haven't necessarily been the best performers, over the past year or two, but what am I seeing here? Okay, what exactly trades see? Well, I'll tell you right now, actually. Thanks for asking. So here's what I'm seeing. I'm seeing a top here, right? But is this a false breakout, right? We had this downtrend established, and it looked like we were doing a really good job, right? We had this J hook pattern that fired off here very, very nicely. And rather than getting a break retest and then, breaking its previous highs, putting in a higher high, we actually completely rolled over here. And this is something that, you need to be pretty cautious of, right? If this is a false move, remember that saying that I was telling you guys, false moves can lead to fast moves. And look at where we're at right now. Look at exactly where we closed. We closed upon the anchored VWAP from its previous cycle lows, right? So when we put in this bottom around 15, the average, buyer, the bulls were in control of price action. And look at where we've gone. Now, would it surprise me to get a bounce at the anchored VWAP and near the 38.2 fib, retracement level? No, right? I'll be looking to see if we bounce and, can potentially get back above this yellow trend line. But if we bounce and then lose this support level and lose this anchored VWAP, I'm going to be looking at some potential shorts into this ETF. I'm not going to chase it necessarily after it's gone from 21.75 down to 19. That was already a pretty impressive move there. But again, if we bounce up a little bit here and then come back down and break through that anchored VWAP, I think that you can look to target some shorts down to the 1667 area, maybe even just 18, using that anchored VWAP as a little bit of a trailing stop loss. The downtrend could just be getting started, right? We just now had a bearish MACD crossover, about a week ago. This is a weekly time frame right here, so it's a little bit of a larger time frame. You're not going to see these things develop very quickly, in a matter of days, but, rather weeks and months is going to be the potential timeline for some of these trades. Okay, now let's move on. Okay, and we've talked about how tech has not been great, right? How it's been underperforming. One of the leaders, I believe, if I'm not mistaken, Amazon has been the top performing Magnificent Seven stock this year so far, and JP Morgan has some really interesting stuff to say. Sorry, this isn't too clear here. And when I blew that up, I didn't realize till now that, it looks pretty crappy. So I'll read it real quick for you. It says, via JPM, if Amazon Web Services growth is higher than expected, they could see incremental buying and like taking that bet where max loss equals premium spent. So what does that mean? That phrase max loss equals premium spent? Well, this is how some people tend to define their risk via options. Okay, and so let's say you're, you have a large trading account, whether you're an institution, a hedge fund, or a retail trader, and you're spending $1 million, right? Let's say rather than buying $1 million worth of Amazon shares, looking to potentially get a 5 to 10% return on those shares, for instance, what you can do is you can come in there and you can say, hey, well, if I spend, $10,000, or if I spend $100,000 or $50,000, I know that that's going to be the max amount I lose. And if I'm correct and Amazon goes up 5% or 10%, well, then maybe those call options that I buy can double. Okay. And I know that the max risk, the max loss that I can take is the premium spent on those call options. So again, what do we mean by that? Well, let's say that you just spent $1 million on a stock. All right. And what happens overnight and after hours while you're sleeping, the CEO, happens to get in a plane crash. And that plane actually crashed into the headquarters and the whole board of directors passed away, right? I know that's a completely, fabricated and highly unlikely scenario, but most likely the stock would be down massively the next day, right? And anywhere from 10 to 20, 50%, who knows, right? Anything can happen and a stock overnight can potentially go to zero. Now, if you're someone with a large account and you just invested $1 million into it and it goes to zero while you're sleeping, well, you just, lost that entire amount if you end up selling. Versus if you have call options and let's say in your $1 million account, you only, put about 50,000 into there. Well, that, hey, like worst case scenario, I'm going to lose 50K on this trade. And I'm okay with that because I know that I won't lose my whole $1 million. I won't lose $500,000 or potentially even $250,000. I can only lose that 50K. But, if I'm correct on my thesis, well, then that 50K can, turn into 100K, can turn into 150K or 200K, even potentially sometimes on earnings. Now back to what JPM is talking about. They're saying it remains the least debated and most well-loved by internet and consumer investors. Their cash stack sees hedge funds and long onlys buying any dip. And we really haven't gotten any significant dip. But what I do want to highlight is how many times this trend line has been tested here. And it really just goes to show, kind of what they're talking about with hedge funds buying any dip, right? And so, I mean, let's just count it, right? How many times we've tested this trend line, right? We started here once, twice, 3 times over here, 4 times over here, 5 times over here, 6 times over here, a 7th time we've tested this trend line. And these are just 7 different moments in time. I mean, multiple candles have touched it within this time period, within those 7 instances. That just goes to you how strong this trend line is. I mean, if this trend line breaks, maybe that's something to worry about. Okay. But we keep talking about this saying false moves lead to fast moves. What if we do something like this, guys? What if we, let's say we do happen to break this trend line and we just come back into this previous overhead supply resistance, flip it to support and get a little bit of a false move that leads to a fast move to new all-time highs surrounding earnings, right? We have earnings coming up, right? And so maybe this does break down here. Maybe that could actually be a potential buying opportunity again, where your max loss is going to be the premium that you spent on call options, possibly, right? This is just a theory and a potential idea that I have for Amazon. I'm not telling you guys to go do it. This uptrend has been well respected and tested many times. If it breaks, it could actually start the beginning of a downtrend and a more significant pullback. Trade upon your own methods, right? And not just because somebody says something on YouTube or gives you an idea. Now, speaking of bullish ideas, after going over lots of bearish data sets, remember I talked about the possibility of why I think SPY could potentially bounce a little bit based on some technicals. Take a look at Supermicro, okay, SMCI. This stock is now in the S&P 500. It went from being, the largest stock in the Russell 2000 to upgrading from the small caps to now the S&P 500. And again, what do we see? False moves lead to fast moves. Okay, we're just going to reiterate that. We had a false breakout above a bullish target here, was not able to sustain, and that ended up leading to a 30% move in a very quick fashion to the downside. Okay, we were talking about this move as a potential possibility, back in the Discord. But right now, what do we have? Tested here, 1, 2, 3. We could call this 4, 5, 6 times now. Okay, 6 times we've tested this trend line. Is this trend line potentially about to break? And could SMCI head back up to the $1,100 area? That's something that I'm going to be watching and paying close attention to after a massive day today of up 10%. It'll be really interesting, right? Let's say potentially we do get some of that bounce in the SPY. Maybe it's just a dead cat bounce that ends up leading to lower lows. But, it could actually start another little bit of a rally. And when you look at some individual names, it does seem like there are opportunities, right? We're talking about 2 individual names right now, Amazon, Supermicro. There's plenty of other names that I'm looking at. I've even posted a few of them in the Discord here recently. And that's it. Okay, that's basically going to wrap up today's video. Just wanted to give you guys some updates and my thoughts, share some really good data with you, and hopefully you enjoyed it. If you did, smash that like button, subscribe to the channel. You can join the Discord for $10 a month using the link in the description. Basically a way to support the channel, get access to all of my analysis, over 20 plus swing trade ideas every single week inside of there, and also custom scripts, indicators, valuable resources, much, much more. You can sign up for the newsletter if you don't want to pay for anything. That's completely free. That also helps support the channel and, grow the brand. And you can get those directly emailed to your inbox by using the link in the description. And if you ever want to do a one-on-one session, right? Maybe you have some questions and you want to do an interactive Q&A, come to my Ko-Fi page. Click on the commissions tab. There's a link in the description to get you to the Ko-Fi page. And in there, we can go over whatever it is you want, whether it's day trading dynamics, swing trading strategies, interactive Q&A. You can book a 30-minute or a 1-hour session directly through that Ko-Fi page. They also have this pretty cool little buy a coffee button. It's basically just a way to leave a tip or donation for the free valuable content I put out for you guys. Once again, thanks for watching. If you did enjoy today's content, I really think you'll enjoy this next video here as well. So be sure to click on that one.